Hey everyone, it's Tom here from the WB Trading Team. Today, I want to talk about a really important topic in trading, probably the most important, particularly for newer traders, and it's managing your risk. Now, if you've been trading for a while, even if you're fairly new, you've probably seen people discuss this, and you may be thinking, does it really matter, my risk? Are they just saying that because that's suitable for larger traders? What if I want to grow my account, etc.? And I'm here to kind of go through a couple of the absolutely vital reasons why we want to manage our risk as tightly as possible. When I'm talking about risk, what I'm mentioning here is our monetary risk. So how much of our account we're risking per trade. We're going to go through looking at how risk affects our drawdowns and also the psychology of managing our risk. And also I'm going to touch on something that a lot of traders fail to understand, which is how risk ties into margin. And that means how many trades can we actually place on a broker. We're going to cover all that in a second, guys. So let's get started. Just very quickly before we dive in, if you're still struggling with your trading or you'd like to know more about how mechanical hedges are traded, I've put together a free video course for you that will map out and explain everything in detail, along with walking you through exactly how the mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link in the description. You can click through and you can watch that straight away. First, let's talk about risk and drawdown. So here, a table that most of you may have seen before, but basically we're talking about the maximum drawdown and what it's required to get back to break even if you hit that drawdown, which is absolutely crucial when we're looking about risk per trade. So on the smaller drawdowns, it's manageable. You can get back to break even with, no major effort. But when we go down the list, it compounds, it gets pretty bad. And psychologically, the impact is even worse than what's on the screen here, For a trader to get to, say, 50% drawdown, that's a massive amount to get back to break even. And you end up just piling on the risk more and more in a desperate chase to try and get back as close as possible to your starting value. And with this comes the idea of what do we risk per trade? This is why keeping our risk very tight per trade, if we go in and say place 10% risk per trade, you can see a couple of bad trades, you're already going to be in a problem. And that could happen in the space of a couple of hours. And that's when traders start to panic. Limiting that risk to, say, 1%, for example, or certainly not going above 2%, is absolutely the long-term focus that traders need to have. Otherwise, you're just going to get into this situation where you're chasing, trying to get back to break even. You think it'd be good to double down on your risk. And for most traders, it just ends one way. You might get lucky. You might catch a few really big trades, but that's just going to give you the confidence to do that again. And you're not going to learn from that process. So this should absolutely be the kind of wake-up call if you are risking, say, 10-15% per trade to avoid doing that in the future. But let's have a look now at another way that our risk management can affect our trading, and that's to look at how risk and margin tie into each other. So the first example we're going to do, just going to do a very simple trade here. I've got GBP USD open, and we're going to use a 1% risk here. So I'm on an entering account here, so just as a very quick example, nice round numbers. I've got £1,000 in this account. I'm just going to buy the market here. Again, we're not really looking at a strategy rule here. I'm just going to go through how risk affects what we place. And let's say we're going to buy the market with a 15-point loss. And let's do a 2R win, so 30 points up to there. So we'll round it down to just 1,000 in the account. So 1% of that being £10. 10 divided by our stop loss distance, which is 15, gives us a size or a price per point of 0.67. So in here, we put our size, and you can see that if I place this trade, I'm going to lose £10. And if I basically win the trade, I'm going to potentially make £20. So all good, obviously managing our risk there and keeping it to a very strict 1%. But one thing that we want to also focus on is what this does to our margin. So here you can see that I've got a margin requirement of £268 if I place this trade. And that's basically what the broker allocates away to make sure that you can't place an infinite number of trades. So if we place this trade, just place deal here, you'll then be able to see once the trade is live and it's moving up or down, in my balance section now, I have a margin number in here. It was 0 before, it's now 268. And now I have what we call the available equity and the total equity. So total equity is how much is in my account with basically free money that I haven't allocated to a trade, and also the results of any trade, any positions that I have open. But we have this availability here. Now that means that I can only really use up £805 worth of margin on any future trades while these trades are still open. What that means is that I've used up 268 on one trade. If I was going to place the same thing, another 3 times, for example, I'd be pretty much on the limit of my margin. I'd be using up another 800 or so pounds, and it'd be very, very close. So if we have a look now at placing, let's say, the same trade again, and this time we'll use 2% of our account. So we won't go up much here. So we're going to do £20, obviously 2% of 1,000, divided by 15 for a new size, which is going to be 1.3 recurring. So I'll put it into here, 1.33. And you can see now that obviously the stop loss value has doubled, the profit value has doubled, and my margin has doubled. So therefore, if I place this trade, I'm not going to be able to place any more 2% trades. So I've used up more margin because my size is larger on this particular trade because I'm risking more. Okay, the rewards are double as well, but it starts to restrict you quite seriously in the number of trades you're able to place, particularly with smaller accounts. And obviously, if I want to trade multiple markets, I want to trade a few currency pairs, for example, and keep a few open positions at the same time, if I'm trading anything over 1%, we're really going to be able to struggle to place trades. And what you would end up needing to do is to put more capital in to cover the margin, even capital that you wouldn't use in your risk percentage calculations. You need to have more in your account just to be able to cover this available margin that you need. So that's a key reason why we always want to keep a really tight tab on our risk management and make sure that we don't go too wide. Now, there's an even greater impact depending on the market that you choose to trade. So we're here on crude oil. I'm just going to place exactly the same trade as we just did on GBP USD. So I'm going to buy the market. We'll put in 15 points of stop loss, 30 points of profit, and we'll use the same calculation for our 1%. Obviously, 1,000 divided by 100, obviously to get the 1% value, £10 divided by the 15-point stop loss gives me that size. And you can see there again, okay, with rounding down a little bit, but the key difference here is the margin requirement is now double. So even just at 1%, I'm only going to be able to place a maximum of 2 trades or open 2 trades at any one time on crude oil with an account like available equity of £1,000. So it's even more important to be tightly managing that risk if you're going to be trading on certain markets. And there are other markets that are even worse than this. So usually you'll see on most brokers anyway that the major currency pairs, the major indices are the ones with the lowest margin requirements. And if you go up to say commodities, crypto, some smaller indices, some more exotic currency pairs, etc., the margin requirements are going to get worse. So what we saw in GBP USD was kind of the best case scenario. And even then, we could only get 4 of those type of trades placed and open at any one time. On certain markets, I would really struggle to even place 1 trade above 1% risk. So again, it's absolutely vital we make sure we manage that risk as tightly as possible, not just for the drawdown that we saw earlier, but also for this margin requirement. So there we have just a few of the key reasons why managing our risk as tightly as possible is the absolute best solution to go forward long term in your trading. Avoiding the drawdowns, having margin available to take trades, both those 2 things are absolutely key pillars of successful traders. Okay, it might seem enticing to be kind of going for those big quick wins. You open up a £500 account, you put 10-20% of risk per trade on, but it's not sustainable. Hopefully what I've gone through here has shown you that. Certainly, if you'd like to have a chat with one of our team, a little bit more information about how we manage risk carefully, how we use it within our strategies, maybe a little bit more about the margin even, the links are below in the description. But I'm hopeful that was kind of useful just to give you an idea of why people talk about managing risk as carefully as possible, why we look at this as a long-term solution here, not just a case of get-rich-quick scheme, because that's not what trading should be about. And yeah, hopefully it's just giving you an insight into what maybe you need to do to change your trading habits. As always, thank you very much for watching. Hopefully that's been useful, and I look forward to seeing you on the next video, guys. Take care.